Yesterday, we took a look at FICO and we saw that they were great fundamentally. Amazing margins, great cash flows. Main issue was the balance sheet. They had too much debt, way more debt than assets. And so let's take a look at something else in a similar sector, the credit rating. And so today we're going to take a look at Moody's, ticker MCO, and see if they're a better buy than FICO and essentially do a head-to-head between the two. So right off the bat, we see is currently trading for 317. It's gone as high as 363 in the last 52 weeks, as low as 230. Fair value 266. Really, we want to get into it around the $200 level as value investors. And we might want to hold back, reevaluate around 270. Earnings yield, pretty low, 2.68%. That shows how elevated the price is. For this price, we'd want to see earnings somewhere in the realm of $16, $17. And this last year, they came in at $7.47. This year, they're going to come in at $10.07 if they hit analyst expectations, and $11.37 the following. So definitely want to wait for that price to fall. Cash flows, 27% is a crazy number. And we saw 36% on FICO. Typically, it's 32, so it is down a little bit from where it's historically been. On average, it is higher than FICO. This last year, FICO beat it out. Dividend yield, this one actually pays a dividend. So we are just shy of 1%, up from what it's traditionally been. Payout ratio, 37.5%. So it's a very good, solid dividend that they've been growing at double-digit rates. So it checks all the boxes for a great dividend stock. So I would not mind buying the stock as a dividend play alone. Returns, ROE, they actually have equity. It's small, so they do have a very high ROE. You can see 5.7 debt to equity ratio. ROI, 13%, so they're fetching a decent return on their money. FICO, it was 21.5%. ROA, 9.5%, and FICO, it was almost 26%. So we do see a pretty big difference in the returns here. And it does look like FICO is getting a much better return on their money. Profits, 70% gross, 72% average, down from the 78, 75 that we see on FICO. Net, 25%. 30 on average, so their margins were just down this last year. Revenue growth, we see it's been pretty slow recently, especially compounding over the last 2 years. Not much growth. Analysts are projecting quite a bit going forward, so we're going to plug a 9 over here for our thesis. Earnings per share growth had been shrinking. It's expected to grow going forward. Share count, they've been buying back almost 1% per year, so we're going to stick that into our forecast. And assets really depends on the year. Looks like the 3-year CAGR is almost 12%, while the 2-year CAGR is only 7.5%. So they've definitely slowed down on their asset growth. So in fact, let's take this not quite a 10, but maybe a 9. Bring it down a little bit. Liabilities, they've picked up growing their liabilities more recently. So we're going to stick with the 15.5 that we have here. And then dividend growth, clearly they've been growing it over 11%. So we're going to say 11 there. And so here we have our thesis. At current share price, given this scenario, the fair value of the stock in 3 years is going to be almost exactly what the price is today. 311, you're going to make some profit through dividends, so you're going to be up 1% on the intrinsic value of the company. And then over a 5-year period, you'd make 28%, which underperforms the market by quite a bit. The market would be looking for about 26% over the course of 3 years. So you're getting the 3-year return in 5. So you have 2 years of loss because of how elevated the price currently is on this stock. But if you were to buy it at the fair value, you'd be looking at something better. So around 267, you'd be looking spot on the market 5-year, but on a 3-year, you'd still be underperforming by about 9%. That's why we build in this margin of safety. The market typically trades in a few years in advance. And at the margin of safety of, let's make this 20% rather than 22. We'd be looking at outperforming the market by 8%. So almost an extra year of gains over the market. And then on a 5-year basis, outperforming by 20%. So clearly a lot better if you're able to get into it around 213.5. So let's say 215. This stock on average is going to be growing 9.5% per year in intrinsic value given these conditions. These are the thesis that we would look for when they have earnings, when they come out with annual reports. This is what we would be looking for. And if they come in even better on any one of these metrics, it could bump this up. But right now, this return looks like it's essentially in line with the market, maybe a bit better. So it'd be really a value play if it were to drop down to the 213 level. It has been as low as 230, and let's see what the returns would be like for people who bought it there. So on a 3-year basis, it'd be 29%, so you'd be outperforming the market by 3%. And a 5-year basis, 61. So very good outperformance at 230. Given all this, which company would I go for between FICO and Moody's? I would probably invest in Moody's. It doesn't look bad given the correct price, but with how incredibly elevated FICO is, I'd wait it out in Moody's, and then once the price hit a decent level, I'd jump over, because you're getting 9.5% returns here while you're getting 14.3 returns over there. FICO has been one of the best companies that we've looked at, aside from that balance sheet. And Moody's here shows that the balance sheet doesn't need to be as bad as it is for FICO. Now, over time, it's going to get worse and worse, and that's exactly what we saw on FICO. But across the board, we see some pretty nice growth on everything else, and the share price is about right where we would expect. The balance sheet does drag it down quite a bit for the fair value between that and the cash flows, but the earnings and the dividend are just incredible on this one. So for the fact that this one actually pays a dividend and it's much closer to the fair value, if I were to buy one of them today, I would definitely go with Moody's, and then I'd check in with each earnings and see if the thesis has changed for either of them, and if not, find a good point to change over to FICO. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.